This chart isn't showing extreme stock market trends, but rather the very rare fluctuations in the exchange rate between the Japanese yen and the US dollar. On Monday, the yen breached 160 against the US dollar, the first time since 1990. At the end of 2020, it was still trading at 103 against the dollar. This year alone, it has lost about 10% of its value. What has happened to the Japanese yen? The primary cause of the yen's depreciation isn't rooted in Japan itself, but rather high interest rates in the United States. To combat rampant inflation, the Federal Reserve has increased rates a total of 11 times, setting the benchmark interest rate at between 5.25% and 5.5%. This unprecedented aggressive hiking of interest rates may help rein in its own problem to some extent, but has broader, negative implications for the global economy, particularly countries like Japan, who've maintained low or even negative interest rates to spur economic growth and combat deflation. The Bank of Japan, long haunted by deflation, has kept interest rate negative for nearly a decade, and only turned interest rate positive in March at a mere 0 to 0.1%. A high-interest dollar becomes more expensive, while a low-interest yen depreciates because capital fly back to the U.S. to seek high yields. Currently, the yield on the U.S. 10-year Treasury bond is around 4.7%, compared to just 0.91% for the Japanese 10-year government bond. Initially, markets anticipated 3 rate cuts by the U.S. in 2024. However, U.S. consumer prices have remained stubbornly high, as indicated by recent March readings. As a result, market expectations have shifted, now anticipating that the Fed will maintain high interest rates, adding to the yen's recent weakness and clouding its outlook further. The old saying by former U.S. Treasury Secretary John Connally, "The dollar is our currency, but it's your problem," still bears true today.